Some of our listeners may be wondering if landlord insurance is worth it. Well, today we're going to be discussing what it is and why it's helpful to landlords and how it works. I'm Kathy Fettke, and welcome to the RealWealth Show.
You're listening to The RealWealth Show with Kathy Fettke, the real estate investor's resource.
Today we're talking to Darren Nix, CEO of Steadily. He's going to cover everything about landlord insurance, how it's different from other types of insurance, how short-term rentals fit in, and how this industry works in general. And if you'd like to find out more about Steadily Insurance, just go to realwealth.com/steadily. That's Steadily. Darren, welcome to the Real Wealth Show.
I'm glad to be here.
Start with your background in real estate. How did you get started?
I got into insurance and real estate back in the early 2000s. I was serving a bunch of insurance carriers on the homeowner side, helping them figure out how to sell insurance online. I'm a computer programmer by training. And then about 8 years ago, I bought my first rental property in Chicago while I was living in Texas. So I went through the whole out-of-state purchase process. And then my simple formula was to look at different cities that I had lived in over the course of my life and buy in neighborhoods that I know. So I bought in Indianapolis, in Kansas City, in Missouri, Chicago, as I mentioned, of course, in Austin, where I live now. And that was my diversification strategy. So some of my properties have appreciated and some of them have depreciated, which was fun. And that was the beginning of a long journey with real estate, which eventually led into the insurance side of backing rental properties.
Yeah, so you started your own insurance company?
We did 5 years ago. So Steadily is an insurance carrier, and we only have one line of business, and that is rental property insurance. And it grew directly out of my difficulties trying to insure my rental properties over time.
Really?
And believing that there was a better way.
What kind of difficulties were you running into?
I had a property that I bought in Chicago. It was a 3-story walk-up. There's 100,000 of them in Chicago. But the problem was it was built in 1918. Many of them are. And the large majority of agents that I called trying to get a quote had a very difficult time getting anyone to say yes to it. And when they finally did, the price was 6 times what I was paying for the same property value on the homeowner side. And my understanding from my days on the auto and homeowners insurance side is, yes, it should cost a little bit more to insure that property, but it's not 6 times more risky. And that was my first clue that there was something wrong in the world of landlord insurance. And the deeper I dug, the more confident I became that if you build a company specifically to serve rental property investors, you would be able to deliver better, faster, and more affordable insurance.
Amazing. What an undertaking. What did it take to create that?
A lot of time and a lot of money. Unfortunately, insurance is not something that you can do on a shoestring budget. The entry point for doing anything of significance in insurance is typically $20 to $30 million. And that's the entry tag. And then it only goes up from there. And the reason for that is probably fairly intuitive. When a storm hits, you have to be able to take a $50 or $100 million financial hit in one day. And you have to have very deep pockets to be able to do that. And so our strategy was to raise a healthy chunk of capital out of the gate, buy a lot of reinsurance, which is where you transfer 80 to 90% of the risk to a syndicate, and then to carefully begin writing risks around the country and build up a diversified portfolio of risks so that no one storm would sort of knock us out. And then it's just a matter of carefully growing over time. And so we're up to the place now where we're writing $250 million a year of insurance premiums across the country.
That's incredible and so needed at a time when it is getting harder for anyone to get insurance, even on your primary.
That's absolutely true. And we talk a lot about inflation as one of the drivers, and that's true. There's also changes in behaviors of the way that people are buying risks. There's the rise of build to rent and fix and flips, way more hail claims than you would have seen 15, 20 years ago. And the insurance industry just moves really, really slowly, sometimes 4 to 5 years behind a change in the actual economy. And so we as investors are now all feeling that pinch as the market tries to adjust to the new realities.
So what are some of the differences that landlord insurance provides versus your regular insurance on your primary residence?
The main difference is eligibility. So when you buy a homeowner's policy, the insurance company is giving you that policy under the assumption that you're living in the property. And so they're mostly underwriting you, your experience filing claims, your history as an insured. But as soon as you decide to have other people living in the property who are now the ones driving the risk, as soon as you have a property manager that's now in charge of maintaining the property, they have to underwrite that completely differently. And many insurance companies just say, that's not what we do. And as a result, they either say no outright, or the rate that comes back is very, very high, which was my experience. And so first of all, it's finding an insurance company that says, yes, we understand this is a rental property and we want this risk. And then secondly, that they can do it at an affordable rate. The technical differences from a landlord insurance policy to a homeowner's policy is mostly just that in the policy language, it says we're covering this property when it's occupied by a tenant.
Okay. And what does it cover?
It's going to cover catastrophic damage to the roof, fire, water leaks, liability if somebody gets injured on the property. If the kids come in and fall off the porch and something happens to them, that's going to be covered. The theft of goods within the property, if you have washer and dryers and things like that, it's going to cover loss of rent if the property gets damaged. Let's say that there is a roof leak and you have to put somebody up in a hotel for 2 months while that roof gets repaired. It's going to cover that cost. So it's there to make a landlord whole for the catastrophic things that happen to their rental property.
And what if you live in a hurricane-prone area or tornado or fire? Do you have to pay extra? Are you covered for natural disasters?
For the most part, yes. There's a type of product that we're seeing become more common in places like California and Florida, which the technical term is a difference in condition product. But what it basically says is we'll cover everything except wind damage or wildfire damage. So if your property catches fire because somebody was smoking in the property and fell asleep and the couch catches on fire and burns on the property, that would be covered. But if you've excluded wildfire and the LA wildfires happen, that would not be covered. And so in almost every case, if an insurance agent offers you that product, they're going to pair it with a government-funded product that only covers natural disasters. So this would be like a fair plan policy in California to cover wildfire paired with a traditional landlord insurance policy that is X wildfire. And that's a strategy for bringing down the cost, because you could have an insurance company that says, hey, I can handle it if 4 or 5 houses burn down at random in a city, but I can't handle it if 2,000 properties all burn down at once. And that's the way of separating out the risks.
14,000 in our case, yeah.
Yes.
Okay. And so what are some of the more common claims that landlords make?
The most common claim is water damage. A pipe burst, a pipe froze, there's some sort of water leak, and that causes rot or drywall. That's super common. That's about 1/3 of the claims that we see. The second is going to be roof damage. So that's either wind or a tree breaking and falling on the property. Both the water and the wind claims, they happen with fairly high frequency, but usually they're in the $15,000 to $30,000 range. So they're big, but they're not enormous. The third category is fire. Fire claims happen a lot less frequently, but when they do happen, they're enormous. And so a typical fire claim is going to be minimum $150,000 all the way up to the total value of the property. And so if you think about that as frequency and severity, in terms of the amount of money that an insurance carrier is paying out in claims, it's going to be about 30% hail, 30 or roof, 30% water, 30% fire. And then the last 10% is liability claims. So that's slip and fall, getting sued type of claims. And those are the least frequent, but when they happen, they're typically $1 million plus.
Sure. And do you need extra insurance for that? Like a extra policy for liability?
The liability is going to be included in a typical landlord insurance policy, but the limits can be dramatically different based on what you need as a landlord. Mm-hmm. So I would say the most common limit is $500,000, but that's really not a lot. So several folks will ask to bump that up to $1 million or $2 million, which is more typical. And then if you need more coverage than that, that's when an umbrella policy is going to kick in. So the conventional wisdom is that folks should have liability coverage up to their net worth. So if somebody has a net worth of, let's say, $5 or $6 million, one, good for them. Two, that makes them a very juicy target from a plaintiff's attorney standpoint.
Sure.
And so they'll look to get more umbrella coverage to raise up their limits so that they have more protection when something happens.
Good stuff. Okay, and what are some misconceptions people have about landlord insurance?
The number one misconception that I encounter is that insurance companies are making tons of money. And the reality is that
these days,
not these days, but even in prior years, before we put aside the California wildfires, if you look at the aggregate results for property insurance, in a typical year, an insurance company will lose money in 15 states and make about a 5 to 6% profit in the other 35. And so on balance, insurance is about as profitable as grocery stores, which is about a 2 to 3% profit margin.
Oh my goodness.
And so the way that insurance companies make business is by being enormous and making a very small margin on a very, very big pool of risk. And so there's this narrative that I hear from time to time about insurance companies, being price gouging and these other behaviors. And I say, well, that sort of flies in the face of their financial results, which are that as an industry, it's very low margin. And I think that if you were looking at this from an economist perspective, you would say, great, there's just enough profit to keep the insurance companies in business, and then the rest of it gets paid out in claims.
Fascinating. What if you're going to short-term rental the property? Do you need special insurance for that?
You do. It's called an endorsement, and it will typically be an extra line item in your policy documents that say this is covered for short-term rentals. The cost is going to be a little bit more. Expect to pay about 5 to 6% more for a short-term rental than a long-term rental. And that's to cover the fact that you'll have more claims. Damage happens more often. The property is going to be vacant for short periods of time in between tenants. And vacancies are the period of time that are the most risky for a property. Because if you just imagine, let's say that you have a water leak and you have somebody in the unit 24/7, they're going to notice pretty quickly that there's a blotch appearing on the roof of them or there's water pooling in the bathroom. But let's say that same exact leak happened and you've had 10 days between tenancy. Now something that would have been a $3,000 repair turns into a $30,000 repair because it was allowed to grow. And that's reflected in the increased cost of short-term rental property insurance.
I see. Yeah, that makes sense. Okay. And I don't know if this is true or not, that more people are renting versus owning in the past. Do you happen to know the percentages?
I do. So I was looking at this earlier this morning, oddly enough. When you go back to 1970, the percentage of owner-occupied housing has been fluctuating between about 65 and 67% over the last 50 years. It spiked, home ownership spiked up during COVID and then kind of went back down to the baseline. It's a remarkably stable number. And so there's this narrative that I hear about, more and more people are renting. It doesn't show up in the stats, at least not at the national level.
Yeah, I would say that. I hear that a lot too. And then I go check the stats and like, well, I'm not seeing that. It's just, One would think so because interest rates are high and home prices are high, but the stats seem to stay the same. It's amazing. Maybe because wage growth has been good or.
Right. And even when the stats do move, they move within a relatively small band. It's not as though we've moved at any point in history from 35% renters to 50 or 60% renters. It moves within a band of 2% up or down. So it's quite predictable that over the long term, 35% of people in the US are going to be renting.
Do you see certain states or certain areas where that percentage differs, where there's more renters than owners?
Landlord insurance, it probably doesn't surprise you as an urban phenomenon. So if somebody is living in a rural area, it's much more likely that they own their property. And so, yes, you can almost map out where there's going to be a lot of renters by simply looking at where the big cities are.
Yeah, and they're more expensive to own and less options for you.
And also more labor market fluidity. So one of the things that drives rental behavior is just that someone knows that they're only here for a while. And so the economics of buying a home doesn't make sense until you're ready to settle down for good.
And are there certain cities where you see more claims than others? And I'm thinking maybe specifically, like you said, Chicago, where maybe the housing stock is older and it's just going to break down more.
The frequency of normal claims, like the non-catastrophic damage claims, are pretty flat across the country. There's not really hotspots. Where you see very significant hotspots are on weather-driven claims. So if you own a property in, let's say, Chicago as an example, Chicago doesn't really get a lot of natural disasters. Sure, it snows, but the houses are built for that. And so it doesn't really matter all that much. Whereas if you take Dallas over the last 10, 15 years, a lot of hail storms, and those are very damaging to those roofs. And so we see a lot of hail claims in Dallas, but not that many in Austin, even though it's not that far away. And then if you keep going over to Houston, you basically get almost no hail claims, but now you're getting hurricane claims. And so it's extremely regionalized, and that is very much reflected in the cost of insurance. And so as folks are considering different geographies, 150 miles can make a world of difference in terms of what they should expect to happen from a catastrophic weather damage to their property.
And the cost of the insurance because of it. Yeah, I mean, we used to joke, hey, if you buy or own a property in Dallas, you get a new roof paid for every 5 years. But I guess you're paying for it really in the cost of the insurance.
You are. There's no free lunch. So at the end of the day, that cost is going to come out in the wash.
Because I imagine you know, with your background in computer programming, that you would somehow be able to calculate the risk as the insurance company, right? You would be able to average out the cost of the claims and be able to know what to charge people so you don't go out of business.
Yeah, it's actually kind of interesting to think about it in reverse. So I'm a pilot, and I have to get insurance on my aircraft. And they quote you a price, and then you know that they're making, they probably have 30 to 40% overhead of like running their insurance company, making 3 to 5% profit. So then you can take the price that they're charging you per year, take the cost of the airplane, and do the math backwards to say, okay, this is the rate at which they expect this airplane to have an accident.
Oh, okay.
A little bit scary to think about.
Maybe more often these days.
Maybe more often these days. But you can do the same thing on your housing insurance. And so if somebody is quoting let's say 1% of the property value in the cost of insurance, well, then that's telling you that they're expecting that house to be to have to pay a limit loss, like the entire value of the property. They're expecting to have to pay that about once every 60 years.
Excellent. Well, any last comments for our investors who probably are feeling a little stressed about insurance these days?
The number one thing that people can do to reduce their cost of insurance is to imagine that they're on the other side of the table and they're an underwriter. What is going to make the underwriter happier to insure this property? And by happier, I mean offer a lower rate. The underwriter is trying to predict the probability that a claim is going to happen. And when somebody says, hey, I need a $250 deductible, what the underwriter hears is, oh, anytime you have a broken window, you're going to file a claim. So they're going to charge a lot more for that than somebody who says, I want a $5,000 deductible. Because the $5,000 deductible says, I'm only going to come to you when something pretty bad happens. And therefore, the frequency of claims is going to be a lot lower. So that's going to be reflected in a much more affordable cost of insurance. So as folks are thinking about how to reduce their cost, one is obviously property selection and thinking a lot about natural disasters. But two is, to what extent can you self-insure? And that's really what a higher deductible is. And that will make the pro forma for a rental property pencil a lot better if you can afford to bear some of that risk yourself.
That's super helpful advice. Thank you.
You're
Love
welcome.
it. And thank you, Darren, for all you do for our Real Wealth members. You have been a great resource for our investors looking for insurance. So thank you for the ways that you've served our members.
We're delighted with the partnership and happy to help. Thank you.
And thank you for joining me here on the Real Wealth Show. Again, if you would like to follow up and find out more about Steadily Insurance, just go to realwealth.com/Steadily. That's STEADILY. I'm Kathy Fettke. Thanks for joining me here on the Real Wealth Show, and we'll see you next time.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.